Welcome to Unit 2. Financial mistakes kill investor interest. In Unit 1, we talked about building your investable thesis. Now we need to prove you can execute it profitably. I've seen promising space businesses crash during financial diligence because their numbers didn't add up. Great technology, strong market opportunity, but when investors dug into the financial model, it fell apart. Common challenges in the space sector for upstream companies include long development cycles, massive capital requirements, and regulatory complexity. For downstream, challenges can include fragmented markets, rapid pace of technological change, intense competition, or the heavy dependence on public policy and procurement. If your financial model can't handle this, neither can your business. In this unit, I'll show you the 5 critical areas where space businesses succeed or fail financially. First, know what investors actually review. Every Series A to C investor starts with your financial package. They want 2 years of historical P&L and a credible 5-year forecast. Not aspirational curves, defendable numbers only. For capital-intensive businesses exposed to delay risks, cash flow timing matters more than growth rates. Make sure you have this covered. When we raised our Series B, investors spent more time on our cash runway analysis than our revenue projections. Why? Because in space, development can take longer, can have several dependencies, and costs can be more than you expect. Second, build revenue models that survive scrutiny. The fastest way to lose credibility is showing hockey stick revenues with no supporting logic behind them. Global satellite internet providers, for example, wouldn't rely on the total broadband market to justify their projections. Instead, they are more likely to focus on specific, clearly defined customer segments, confirmed contracts, and realistic deployment schedules that underpin recurring revenue assumptions. Build weighted pipeline analysis. Show me your £50 million pipeline broken down by probability. Qualified prospects at 70%, early discussions at 30%. Third, unit economics expose everything. This is where most space businesses stumble. Investors will drill into satellite build costs, launch expenses, regulatory compliance, and ground station operations. Every cost element needs validation. Companies like Planet Labs PBC, when pitching for their Series C, would likely have had to detail cost breakdowns per satellite, launch cost projections across multiple providers, and margin evolution as they scaled production. That's the level of detail investors expect. Fourth, headcount planning reveals management maturity. Don't show unexplained headcount jumps. Explain why you need that VP of sales now, or why regulatory affairs can wait until Series B. We learned this the hard way. Our first pitch showed 40% headcount growth with no rationale. Investors questioned whether we understood our own operational needs. We revised and succeeded. Fifth, risk planning separates winners from losers. Another key thing investors really want to see is that you've thought through what could go wrong. Supply chain disruptions, launch delays, regulatory changes, key customer losses. Whatever they could be, model these scenarios and show survival strategies. Investors in companies like Rocket Lab would have needed to get comfortable with the risks, which is why they would have seen through early setbacks. Now, let's look at the 3 fatal mistakes. First, optimism bias. Showing 300% revenue growth when you've never sold to enterprise customers before. Sorry, but investors have seen this movie before and know how it plays out. Second, ignoring working capital. Government contracts take 90 to 120 days to pay. Factor this into your cash flow model or you'll run out of money. Third, grant dependency. Treating ESA grants as recurring revenue or hiding regulatory compliance costs. These get exposed very quickly in diligence every time, so don't make this mistake. So, how do the best companies get it right? Successful space businesses build financial models from the bottom up. Every assumption links to a source, ESA pricing tables, supplier contracts, Ofcom fee schedules. They run mock diligence sessions before they pitch and invite advisors to stress test their models. Most importantly, they're transparent about unknowns. When launch vehicle manufacturers are raising funds, discussions are likely to include risks related to scaling their manufacturing, particularly around matters such as scaling up 3D printing technology or outlining strategies to manage challenges documented in their investment guides and sector reports. That honesty builds confidence. Our support materials offer guidance in financial model essentials. For now, here's a financial readiness checklist. Build bottom-up financial models with validated assumptions. Segment revenue streams with weighted pipeline analysis. Detail unit economics that reflect space sector realities. Plan headcount with clear hiring rationale. Model risk scenarios and survival strategies. Your assignment? Take your financial model and trace every assumption back to its source. Run sensitivity analysis on your 3 biggest risks. Then, find an advisor who's been through institutional rounds and let them tear it apart. In our next unit, we'll show you how to organize these financials into a data room that proves you're ready for serious institutional diligence. Remember, investors don't fund perfect models. They fund founders who understand their numbers and plan for reality. See you in Unit 3.